You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. It is Thursday, January 22, 2026. The coffee is, well, it's definitely strong, and the markets are doing that weird dance they do before the opening bell. And here at Vocal Technologist, we're going to just go ahead and declare this an honorary Founder Friday.
Is that officially allowed? I'm pretty sure there are rules against that.
Look, in fintech, time is relative. If a company can double its valuation in 4 months, and we are definitely getting to that, then I can absolutely turn a Thursday into a Friday. But seriously, we have so much to get through today. And I'm not just talking about, big VC checks changing hands. I'm talking about the actual machinery behind the money. It's shifting.
It really is. I mean, we're looking at these fundamental changes in what even is the unit of work anymore, how risk physically moves through the system, and the NYSE building, like a portal to another dimension.
A parallel dimension for money. Yeah, we have to talk about that. We're going to cover AI that has grown arms, founders who built these billion-dollar companies on 100-hour work weeks, which just makes my back hurt thinking about it, and the weird physics of risk. Oh, and apparently the White House is now fighting with data centers.
The physical world always strikes back. It was bound to happen.
Exactly. And you're the one who actually reads the fine print while I'm just scrolling headlines. So let's jump in. I want to start with this idea of AI growing arms. Because for the last, 3 years, we've been treating AI like this really smart, sometimes hallucinating chat buddy.
Right. It was a generator, an oracle. You put a prompt in, you get text out. It was totally passive. It waited for you.
But the stuff coming out this week, I'm thinking of tools like Claude Code, Claude Coworker. The language is different. The term I keep seeing is autonomous coworker. Now, that feels like a stretch to me.
Yeah.
Is that just marketing, or is something really different happening?
No, it's a genuine architectural shift. We're not just talking about a model that predicts the next word. We're talking about agentic workflows. When they say AI has grown arms, they mean it has been given tools and the permission to use them.
So it can get into my terminal. It can access my files.
It can access your file system, and crucially, it can execute.
Okay, so it's not just writing a bit of code and then waiting for me to copy and paste it. It's writing it, running it, seeing the error, and then, fixing its own mistake.
Exactly. It has that iterative loop. It can critique its own work, and that is the big shift from chatbot to coworker. A chatbot makes a mistake, it just stops. An agent sees the error, adjusts, and tries again. It completely changes the bottleneck in a company.
Okay, let's unpack that, the bottleneck.
Right.
Because, traditionally in Silicon Valley, the bottleneck was always hiring. You wanted to ship more stuff, you had to hire more engineers. That was just the rule.
Precisely. Headcount was your proxy for velocity, but now the bottleneck is shifting away from execution, the actual typing of the code to judgment. It's about how you frame the problem. It's about orchestrating these agents.
And we have a real-world example of this that, honestly, kind of blew my mind. Let's talk about Brex.
Yeah.
They put out some numbers that just don't seem possible under the old rules.
This is a perfect case study. So Brex had a period where their growth just stalled. And normally the playbook is, okay, hire a ton of sales reps, hire more engineers. Brex didn't do that. They kept their engineering headcount flat.
Flat headcount. In a growth phase, that's usually a disaster signal, right? That you're out of money.
Usually. But instead, they went all in on an internal AI strategy. They built a multi-agent platform to handle the really unsexy heavy lifting. Know your customer checks, underwriting, finance workflows.
The stuff that has to be perfect.
Right. And the result?
That was the result.
They blew past $500 million in annualized revenue. They scaled the business without scaling the payroll.
That is the dream for a founder, and it is the absolute nightmare scenario for a junior employee. Because it sounds like they replaced more bodies with better bots. They decoupled revenue from headcount.
That's the economic shift, which of course brings us to the question everyone's asking.
Is AI taking all the jobs? I mean, if Brex can do that, what happens to the kid who just graduated with a comp sci degree?
It's the fear, for sure. But when you actually look at the macro data, the story is, it's a lot more nuanced. There was a fascinating analysis that looked at hiring in AI-exposed roles. Copywriters, coders, that kind of thing.
And I'm guessing the chart just falls off a cliff the day ChatGPT launched.
You'd think so. But the decline in hiring for those roles actually started months before ChatGPT was even a thing.
Wait, really? Before the tool even existed? How?
Correct. The decline lines up almost perfectly with the Fed starting their aggressive interest rate hikes in early 2022. It matches all the post-COVID return to sanity patterns.
So it wasn't the tech, it was the cost of money.
Exactly. It suggests that, so far, macroeconomic forces have been the main driver. Companies were cutting costs because money got expensive, not just because AI got smart.
That is a really critical distinction. It's easy to blame the robot, harder to blame the central bank.
Yeah.
But looking at the money pouring into this sector, investors definitely believe the automation is coming.
Oh, absolutely. The capital markets are fully priced for it. I mean, did you see the numbers on that Sequoia investment in Anthropic?
I did, and I had to count the zeros a couple of times.
It's just staggering. This round could value Anthropic at roughly $350 billion.
$350 billion. That's bigger than Bank of America. It's bigger than Coca-Cola for a company that's, what, 3 years old?
And that valuation has doubled in the last 4 months.
That just has to be a bubble.
Ah.
You can't double the value of a company that big in 4 months.
It feels like one, but I think it signals a change in how VCs view these companies. They're not just software startups anymore. They're being treated like nation-state level assets, like the future utilities, electricity, water, intelligence. You don't value a utility on next quarter's profit.
Right. You value it on its 50-year dominance. Okay, so speaking of building dominance, let's pivot to our Founder Friday theme. Because while AI agents are doing the work, you still have humans at the wheel. And I feel like grit is the one thing you can't generate with a prompt.
You definitely can't. And that brings us to Jack Zhang, the CEO of Airwallex.
I love this story. So Airwallex is this huge $8 billion company now, doing $1 billion in revenue. But the origin isn't, some Stanford kid who breezed through.
Not at all. He moved to Australia from China as a teenager, pretty much on his own. And to pay for university, he worked up to 100 hours a week.
100 hours.
Across 4 different blue-collar jobs. We're talking kitchen hand, cleaning.
Yeah.
Just pure labor.
That kind of survival ethic?
Yeah.
I mean, it puts things in perspective. I complain when my calendar is full. This guy was grinding 100 hours just to get through school.
That's the founder effect, right? That instinct gets baked into the company's DNA.
Yeah.
And you see that intensity playing out in the market right now.
Right, because when you have cash and that kind of ambition, you don't just build, you buy.
Yeah.
We're seeing a lot of really smart tactical acquisitions.
It's a consolidation phase. Look at Payoneer. They just got a company called Boundless.
Which is an employer of record platform, right?
Correct. So say you're in the U.S. and you want to hire someone amazing in Brazil. You don't want to set up a whole legal entity there. Boundless does all that for you.
Which is a perfect fit for Payoneer. They already do the payments. Now they can just say, we'll hire your people for you too.
It's the whole value chain. And then maybe even bigger, you have Stripe. They just closed the Metronome acquisition.
Metronome. Usage-based billing. That sounds incredibly boring. Why does Stripe care about that?
It sounds boring until you realize that usage-based billing is basically the operating system for the entire AI economy.
Because AI isn't a flat monthly fee.
Exactly. You're paying by the token,
right,
by the compute second. It's incredibly complex to track that in real time.
So Stripe buying Metronome is Stripe basically saying, we're going to own the cash register for the AI revolution.
Precisely. They're buying the plumbing. It's brilliant.
It is always Stripe. Just quietly building the infrastructure for everything. Which, it begs the question I feel like I ask every 6 months. When are they going public? Are we ever going to see the Stripe IPO?
Patrick Collison, one of the founders, just talked about this. And the answer is basically, why rush?
Still, even with this market.
He says there's no urgency. And honestly, for companies like Stripe or Airwallex, staying private gives them so much flexibility. You don't have Wall Street breathing down your neck every quarter. You can make these long-term bets like buying Metronome without worrying about quarterly margins.
I guess when you're that big and profitable, you don't need the public markets. You can just keep building the empire in private.
Exactly.
Okay, so we've got AI agents doing the work, founders with this incredible grit, huge monopolies being built. It all sounds great, but this is where I get nervous. Because in finance, when things move this fast, physics gets involved.
Yes, the thermodynamics of risk. It's one of my favorite concepts.
That sounds like something I would have definitely failed in college.
It's a simple idea. Technology in fintech doesn't eliminate risk. It moves it somewhere else. Energy can't be created or destroyed. Risk is the same. You lower the friction in one place, the pressure has to build up somewhere else.
It's like squeezing a balloon, right?
Yeah.
You push down on one side, the other side just bulges out.
Precisely. You transform underwriting risk into, say, fraud risk or concentration risk. And companies get into trouble when they forget to check where that risk has landed.
We have a perfect and kind of controversial example of this right now. A firm partnering with Isuzu to offer buy now, pay later for rent.
A huge development. Renters can split their monthly rent into 2 bi-weekly zero-interest payments.
On one hand, I get it. Your paycheck might not line up with the first of the month. This gives you flexibility. But on the other hand, financing your rents, that feels like a dangerous line to cross.
That's the tension. It solves a liquidity problem for the tenant. But consumer advocates are worried. I mean, rent is the ultimate essential expense. If you start financing your essentials, you're not getting rid of the risk of not having money. You're just pushing it 2 weeks into the future.
You're just redistributing the pain. That's the thermodynamics.
And sometimes the risk shifts from your finances to your security. Look at what happened with Betterment.
The data breach.
Yeah. Hackers sent out fake crypto scam notifications to users. Now, importantly, no money was stolen. The actual vault was secure.
But the front door was compromised. Can you imagine getting a push alert from your investment app telling you to click here for a crypto airdrop?
Exactly. The risk shifted to the communication layer. The money was safe, but the trust was attacked. And that's a whole different kind of cost.
It's scary. It attacks your psychology, not just your bank account. And speaking of risk, we have to touch on this showdown in Washington. And, remaining neutral here, but this is a massive collision of philosophies on risk.
It really is. It's Main Street versus Wall Street, literally.
So on one side, you have President Trump proposing a cap on credit card interest rates at 10% for 1 year.
That's a huge intervention. Most cards are what, 20, 25%? This would slash their revenue model.
And on the other side, you have Jamie Dimon from JP Morgan basically saying this would be an economic disaster.
His argument is classic risk thermodynamics. He says if you artificially cap the rates, banks just won't lend to risky borrowers anymore.
The reward no longer justifies the risk.
Right. So the credit supply just dries up. The very people you're trying to help, people with lower credit scores, they get shut out of the system entirely.
So the political goal is relief, but the economic result could be exclusion.
That's the risk redistribution. You don't remove the high interest, you just remove the access. It's a fascinating standoff.
It is. Okay, so if the current system is full of risky rent payments and political fights, maybe the answer is just to build a whole new system.
Well, the New York Stock Exchange seems to think so.
This was the story that really made me do a double take. The NYSE, the symbol of traditional finance. They're going on-chain.
They're building a fully parallel exchange for tokenized equities.
Okay, break that down for me. Not just trading crypto, trading actual stocks, but as tokens.
Exactly. Natively issued tokenized securities. And it'll have all the crypto features you'd expect. 24/7 trading, instant settlement, stablecoin funding.
Instant settlement, that's the magic phrase. Right now, if I sell a stock, the money is in limbo for, what, a day or two?
T+1, yeah. And that delay traps trillions of dollars in capital as collateral. If you move to instant settlement on a blockchain, all that capital gets unlocked. The market becomes way more efficient.
And what's interesting is they're not tearing down the old system.
No, they're not retrofitting. They're running this new digital market alongside the old one. It's a hedge. They're betting on the future, and they want to own the infrastructure for that, too. They see the volume on crypto exchanges, and they're saying, hey, we can do that, too.
And it's not just exchanges. It's entire countries, right? Bermuda is moving its whole economy on-chain.
They're partnering with Coinbase and Circle. The goal is to lower transaction costs, be the first fully on-chain national economy. They're starting with government stablecoin pilots for things like taxes and payroll.
That's wild. We've gone from crypto is for JPEGs of monkeys to crypto is how a country runs its payroll.
That's the shift. Stripe is partnering with Crypto.com. Visa is adding stablecoin payouts.
It feels like crypto, as speculation, is finally maybe ending, and crypto as plumbing is starting.
I think so. It's becoming boring. And in fintech, boring is usually a really good sign that a technology is actually useful.
Boring is good.
Yeah.
I like boring plumbing.
Yeah.
So let's recap. We've gone from AI agents running companies to founders grinding 100-hour weeks to the physics of risk, and now a parallel stock exchange that never sleeps.
It paints a picture of a financial system that's just getting faster, more automated, more integrated with code.
It feels like we're accelerating. But you mentioned there's one final hurdle, one thing that isn't digital at all that might slow this whole thing down.
Yes, electricity.
The most basic constraint of all.
We can talk all day about AI models and tokenized rails, But they all run on physical servers that get hot and consume enormous amounts of power. And now the White House is cracking down on data centers because of electric rate shock.
You're saying these AI centers are using so much power, it's actually raising utility bills for everyone else.
That's exactly what's happening. Surging electricity costs from the AI build-out are pushing policymakers to look at new rules, maybe shift those infrastructure costs onto the tech companies themselves.
That's the ultimate irony, isn't it? We have the AI brains of Anthropic, the payment rails of Stripe, but the thing that might actually hit the brakes is just the cost of keeping the lights on.
It's a reminder that even the digital economy has to live in the physical world. You can tokenize a stock, but you can't tokenize a watt of power.
Well, on that very grounded note, I think that's a good place to stop. Thank you for lending us your very human judgment today.
My pleasure. Always great to be here.
We'll be back next time, hopefully with insights that don't require 100-hour weeks to figure out. See you next time on Vocal Technologist.
Spoken Tech for your ears.